Um, well, so number one, it's get your company ready for a raise. So have your story ready. The deck doesn't have to be beautiful. I think a lot of people spend too much time just trying to get like the super flashy deck. It just needs you to need your problem solution.
Hmm.
Obviously, traction is very important. Have your story right, and then you're ready and prepared to go raise.
I like the
And
team slide, like
yeah,
really get that's your story right, which is like,
right.
why are you the right
Early
team? Why
stage,
now?
especially. Yeah.
Yeah.
I like on the early stage companies, I prefer the team slate in the beginning. If it's a later stage company, team slate can be on the back because then the story of the company speaks for itself. But yeah, you're right. Because in the beginning, investors invest in the startup founders.
Hey everyone, welcome back to the Ignite podcast. This is a very exciting episode because we have Steph Rieben on the pod. And it's episode 100, so no pressure on her to do a good job as a guest. Steph, welcome to the program.
Thank you. Love it. What double O.
100. We've hit the 3 digits here at the Ignite podcast. I love doing this.
Congratulations.
I know, it's so much fun. We're about a year in to doing the pod, and love having amazing guests like you on the program.
Thank you. Appreciate it. Thanks for having me.
Yes, would love to get an intro from you for the audience.
Sure. Steph Rieben, based in New York City. Actually, I'm now in the burbs, so Westchester, New York.
Oh yeah,
Moved out there pre-COVID, but before that, 14 years I lived in New York City. It's
what
Wall
neighborhood?
Street. Well, in New York City,
Yeah.
every neighborhood.
Oh,
So I think I moved, which is a problem of most New Yorkers. You move like every year or 2 years because your rate
yeah,
goes up, and you're like,
right.
how am I supposed to afford rent right now?
Yeah.
Because your raise, like your salaries don't go up the same amount as like rent increases. This place I stayed the longest and loved was Battery Park. So Battery Park City, Southwest, right on
Right
the
down at the tip
water.
there. Yeah.
Yeah, right on the tip. Perfect for commuting in New York City because all the subways meet right there, so you can go wherever you want real quick.
Yeah.
But I
Yeah.
lived down there because I worked for Citibank for 10 years. And Citi is down in Tribeca, so I could just walk to work, like a 10-minute walk, really
Nice.
nice.
That's
I
amazing.
lived in the West Village as well, Midtown, like all over.
I lived Upper East Side, and I worked down on John Street, down Wall Street, and I would catch the 6 train, and with 15 of my closest friends touching me that I don't know on the train every morning,
Yes.
and I'd have to switch at 59th to the 4 and 5.
Uh-huh.
It was, yeah, that commute was not fun.
Good days.
Yeah. Well, walk us through your background. Why did you go into banking? What'd you do there? And then we'll get to like what you're doing now.
Yeah, totally. So I'm a career switcher. So I studied actually hotel management undergrad in Switzerland, came to New York, worked for the Grand Hyatt New York and did event sales at two financial institutions. So all my clients were the banks, all the ones that are no longer around. So Lehman Brothers, Bear Stearns, Merrill Lynch. You get that was pre 2008.
Yeah.
And then the crisis hit, and I was like, what am I going to do? And in order to get into banking, the only way to get in once you have already established in your career is to get an MBA. So I went to Georgetown, spent 2 years in DC during the crisis, which is the best time to go to school, and graduated 2010 and then started my banking career. So I worked for Goldman first. So when you said John Street, I used to live on Wall Street, and then I was at the Goldman offices at One New York Plaza, so the big tower at the very tip of Manhattan. That was before they moved over to like Battery Park City or World Financial Center, as it's called. And then later worked for Citibank. Spent 8 years there. That's where I met my now co-founder, Joe, and spent half my career in investment banking, half in capital markets. So Joe and I met on the trading floor when I was in capital markets and was part of a team called City Velocity. And City Velocity is a data and analytics platform for the buy side to make their investment decisions. So on public equities, public credit, FX, cross-asset tool, basically. And then from there, I went to another bank. So I spent like over a decade in banking altogether. And the last bank is called Berenberg Bank, and they actually got me into the tech world where I'm now. So Berenberg writes all their equity research with a tech spin. So financial services, they write fintech, healthcare, it's medtech, biotech, real estate. They wrote like on data centers. They were well ahead of like their time back then. And we were scouting the US to find pre-IPO companies that we could take public. And that's where I first was like, what is this tech world? I never knew about this because I was like all like on public companies. And then I jumped over to the tech world, worked for two fintech startups back to back. Both were funding marketplaces. One was like a real estate marketplace helping regional banks that have loan books to sell them off to insurance and PE shops. And my role was basically to find the investors that want to buy it. And I also helped the founder raise his first fundraise. We raised like 5 million back then. Then I joined Capital pretty much right before Series A. They were raising a 21 million Series A back then, funding marketplace connecting private companies to debt. And that's really where the idea came then of Diadem Capital today, because every founder I talked to there was like, well, I don't want debt. I want equity. Help me get equity. I'm way too early to get debt.
Right.
And then I was like, how can we do this? So that's where I had already Diadem Capital as like a fundraising advisory shop, but I just did like one-off like pitch deck work more than actually fundraising and matchmaking. And because I have a FINRA SEC licenses, I always had a broker dealer that I had that company with in order to be able to take success-based fees.
Right.
Anyway, so while at the other startup, we were like, okay, let's start doing this. We were doing it for them. And then 6 months in, I was like, this is actually going really well. Maybe we should do this on our own. And by then, Joe, who's now my co-founder, I had asked him to leave Citi, join me at this other startup to then work, though, on the startup within the startup. And so 6 months later, we spun out our entire team. So 3 people, we left together. We had like a rev share with on like deals that we were taking on that they gave us. And then we like shared it with them. For 1 year, we had a non-compete to not do debt because that's their bread and butter is debt. So 1 year, we only did equities. And we're now 2.5 years old. So last year, we then added debt. And now we're basically a marketplace funding platform where we'll help startups to get equity and debt as they grow. So we start at pre-seed, we go all the way up to Series C. We're sector agnostic. B2B SaaS is the biggest sector though, because most of the VCs are in that space. Fintech, obviously, because we're New York City based, so lots of fintech, right. Financial services, and anything else you can think of, CPG even, and consumer. Yeah. But they're more debt candidates typically than that we help them on the equity fundraise.
That's amazing. What a cool journey to get into this little niche, right? That you find yourself in, or big niche, if you will. I wonder how has it changed? I mean, 2.5 years in. I mean, obviously, 2 years ago, we're sitting at the beginning of 2022 when you kind of kicked this off. Much different fundraising environment, right?
I know. I feel like we picked the worst time to start a fundraising advisory startup that you could think of. Like 2020, everybody got like money thrown at them.
Yeah.
2022, very different ball game. But the good thing is we actually started at the right time because people need even more help. Yeah. But it is a tough environment. So when we like started like advising in like 2020, 21, it was like easy. An equity fundraise could take like 2 months, 3 months, 4 months. Now the average fundraise that we're working on is like between 4.5 months to the longest we've ever done was a 9 months fundraise. And that was on the consumer side. And that's why we're like, okay, we're not doing consumer anymore.
Yeah, consumer's tough.
Consumer is tough.
All
they
my
need to show like a ton of traction.
Yeah. 140 portfolio companies now, like pretty much all of them, all my shutdowns of like all 5 or 6 of them are consumer. So it's just, it's a tough space.
It's tough because they have to throw so much marketing at it.
And it's low margin and consumers aren't willing to pay for stuff. And
and then inflation hit everybody, right? And there specifically,
Yeah. Consumers like, I'll just get it from free, right? With Amazon Prime or whatever.
Right.
I already pay for Spotify. Why would I pay for that? That's just how they think, right?
Yeah.
It should come like for free with my healthcare, right? Like it just like this, that's the consumer mindset.
Yeah.
I'll get it at Costco. Yeah. It's included in my Costco membership. And the list goes on, right? They're just used to like getting freebies. So it's pre-seed all the way to Series C. What rounds right now are you finding the easiest to fill between, all of those?
Yeah, so there was just like an update on the state of like venture, and we're definitely seeing it as seed is like the strongest. Like seeds are like flying off the shelf.
Yeah.
Series A's and B's, they're hurting because they're the ones that like just raised so much 2 years ago and they still haven't grown into the valuation they should have had back then because they were just overvalued back then.
So they raised a big seed, a big $3-5 million seed at, some like, I don't know, $40 million valuation or whatever.
Yeah, crazy
a couple
multiples.
Years ago.
Yeah.
And now they're like, hey, we're up to, what's the revenue hurdle that you're seeing that where you're getting these A rounds done at right now?
Yeah, so typically at A, we're looking at between 3 to even 10 million revenue.
Mm,
So it's more the stronger ones are like at higher revenue, but like
right.
3 million minimum. I would say most of the A's are
And
like
3
at around
million
five.
having probably 4 to 8x year over year.
Yes. Yeah.
Like this high growth, high velocity, rule of 40
High
kind of
growth.
stuff.
Yeah.
Yeah.
And then seed stage companies, we see them more between like 5K and a million.
Right.
So they have to hit like almost like the million mark to be like super excited, like for VCs to get excited. And then pre-seed, we don't do pre-revenue anymore. They all have to have revenue. And
Yeah.
our
You gotta
pre-seeds are
have,
strong.
yeah.
They have like 100K, 200K,
Yeah.
300K revenue at pre-seed.
Right.
So it's just changed a lot, like what is expected from a startup even early on.
Yeah. That's why I like being a pre-series A investor is like you usually get a couple chances at the company. Sometimes I'll look at a pre-seed and it's 100K, but it's like one customer and it's like kind of risky. And I'm like, hey, I like what you guys are doing, but I just want to see you execute a little bit more on the GTM. And then, typically I can come back in and, at the seed and maybe the valuation's doubled, but the risk has also gone down dramatically, right?
Definitely.
Yeah, go ahead.
That's also what some VCs say that are early stage. You're like, well, A and B investing is easy because they've proven everything out. Like you take the true risk, but also you have the highest reward when you invest in like seed stage companies.
Yeah. I mean, I think A's a little different place to be. I don't think I'd ever want to be an A investor because you'd have to take board seats and do governance and like invest in a smaller group of startups. I like being a high volume investor. I like kind of looking at a lot of things and, putting lots of my founders and friends on the podcast. And, it just kind of suits my personality. I don't think I ever want to write $25 million checks. I think somebody like 10 or 20 years from now is going to pull this podcast out and go, see,
like, yeah,
you said you'd never do that, but we'll see. How do you pick companies to work with, right? Because you probably have lots of companies, right? There's 10,000 companies that raise pre-series A every year, tons of market potential, and you probably have your inbox full of people who are like, yeah, please help me fundraise. Like you're probably approaching it like a VC. Like you're probably looking at it just like I am, right? Because you need to optimize your time. You have all these companies that you could work with. Walk us through some of the things that you're looking for as you guys are prioritizing.
Yeah, totally. I mean, the funny thing is we're bridging the two sides, startups and VCs, and we kind of are also both. So we're a fintech startup, we're venture backed, but we're still pre-seed. But we do pick startups like an investor. So we have the same math actually. So about 2,000 startups apply every year. 8% get a call with us. 4% we actually take on to help them with their fundraise.
So half of the calls. So before you even taken a call, you're pretty sure. You're kind of like, yeah, I've looked at the deck.
Yes.
I like what I'm seeing. Maybe you ask some follow-up questions.
And we've automated that process. So every startup gets driven to the site to sign up because there we have qualitative and quantitative questions that help us assess. The biggest ones are we only work with already venture-backed startups. The second one is they need to have revenue. We don't work with pre-revenue startups. Right. And then we obviously look at sector, TAM, and all of that, but the first two questions need to fit so they even get through the rest of the questionnaire where they get on board. And then obviously every founder that we take on has to be vetted by us because we are Series 7, like FINRA, SEC licensed representatives. We have to do reasonable due diligence. So how we do it is every founder has to go to 2 actual video calls, kind of like we're doing right now. The first call is like, we've had the deck already, we've reviewed some questions, we'll let them pitch us. Then we sign an NDA, we get into the data room, we look at the financial model, like their articles of incorporation, you basically check that they're real.
Interesting. So you actually sign an NDA because VCs don't sign NDAs.
I know, right?
Because we just see so much stuff, right?
Yeah, you would never do it, but we do it because we need to be able to go straight into the data room and really dig deep. And then we ask a lot of questions. Like if it's a SaaS company, we ask for contracts, we look for customer concentration. We check like, are these multi-year contracts? When are like they're up for renewal? Like is it December 12th? And by December 30th or 31st, whatever, they'll lose all their revenue because all of them are up. Right. And we do check like that. And then we have a second call where we then go through like true VC-like questions, like everything that they potentially could also hear from a VC. And then when they make it through that, they can go live on the platform. And then the platform is basically like Airbnb, but you log in as a founder or investor and you create your basically investment preferences on the investor side. And on the founder side, you create your profile. So it's like 2 paragraphs blur from the company, kind of like what you're sending around, right? And then you have the pitch deck link, you get traction, like lots of metrics and numbers, funding to date, who are the investors, and then the LinkedIn to the founders. And then basically we just say, okay, do you want an intro, yes or no? But to get to that point, every founder has to go through these 2 calls and like our onboarding where we do vet them. And the biggest things that on the qualitative side that we measure, like a VC, is like, how coachable do we think the founder is? Like, how do we think will they fit to like the majority of the VCs that we have on the platform? Because by now we're almost at 1,000 VCs. So whenever we take a founder on, we do always have in the back of our mind, okay, do the VCs on our platform actually want to look at a deal like this?
Yeah.
So whenever we reject, we can also always say, it's not really us that's rejecting you. It is most of the VCs that are looking for this thing that is a diamond in the rough, and you're just not there yet. So a lot of startups, we also say, we just need a little bit more traction for you to be like a good fit.
Right.
And then we'll check back in with them in 6 months. And in the meantime, they live in the platform on the back end until we're ready to like set them live.
Nice. Yeah. So it's become this almost like the screening mechanism for your VC partners.
Yeah.
Where they know, hey, if it's coming from you, it's probably pretty high quality. It's been vetted. You know, I should probably look at this. It's not just
especially like emerging managers like it. Yeah. Because they're like, I don't have like 4 analysts that do all this work for me. So it's nice to have basically the team of Diadem, which we're 10 people, plus we have tech that are actually reviewing all these startups that are coming
10 people
through.
now?
We're 10 people. Well, 3 full-time, and then we have 7 contractors, but they work like they're full-time.
Yeah, that's amazing. And how has your selection criteria changed over, you know, the couple of years? Like, how has it kind of evolved?
Yeah, that's helpful. So first we started out only doing seed series A. Then last year we added debt, as I mentioned. And now this year we went earlier stage. So now we also do pre-seed. And we also went later stage. So now we're also doing series Bs and series Cs. The biggest checks that have changed is we've listened a lot to our VCs. So the way we built the platform was all the founders that are on the platform obviously need to get matched to investors. How do we learn what investors do? Every single investor on our platform, we're like 998. They all did a video call with me. And by now they've all done like 3-4 video calls with me because I also nurture all the relationships. So like every half year I like check in and make sure, oh, how much of your fund is still left? Like how much dry powder do you have left? How much is deployed? How much are you leaving just for follow-ons? Like, are you raising a new fund? Has your criteria changed? As they raise bigger funds, a lot of funds then also go later stage. So they might have started as a seed, pre-seed, but then later they do A because now they have more capital that they have to deploy. So you have to write bigger checks.
Right.
Or you do the volume game, which can be harder. Anyway, so we've changed a lot how we screen based on that. So we've seen from a lot of VCs, they shared also their memos and like how do they look at companies. They've shared like their scorecards, and that's how that helped us also make sure that our scorecard fits what the majority of like B2B SaaS investors are looking for. We do look at TAM, for example. So like how big is the market?
Just pull the thread on the scorecards for a sec, right? Because we have our own scorecard. You know, we've built it up over years and years, looking at thousands and thousands of decks. What are some interesting elements of scorecards you've seen out there where you're like, well, that's interesting. I never thought about it that way. Or what are some interesting things that you've seen from VCs that you surprised you?
Yeah. I mean, the ones that I like the best is also doing like a weighted average. So basically you have certain things like the financial score, the qualitative score, and then you do your calculations, but how to actually look at it where every team member, whether it's just the people on the IC, but they get a weight. So basically I get to score Brian founder based on my subjective feelings.
Right.
Like, what do I think? Is this founder coachable? Do I think like can execute? Like things like that. And then it puts a weight as your vote is within the IC. So I think that was like really interesting to like try and make it as fair that everybody gets a little weight, but it gets like scored across that.
Yeah.
And then I've seen stuff like management team, they get scored on energy level, pitchability, like on their experience. That's easy because you look at pedigree, fine. But or industry experience. I personally, for example, I don't care where they went to school, but I care where they've worked. Like I think that is more testament to like what they've learned on the job that can actually be used in like the startups setting than just where they went to school. Even though Stanford alums obviously do very well.
Stanford, that's a school in California, right?
Yeah.
Right.
It's
I've heard of it.
Yeah.
I went to Berkeley, so we kind of tease them any chance we get.
I getcha. And then the industry TAM is something that's so hard to like measure because every founder, when you look at like the TAM slide, you're like, I don't know if that's really the TAM. But then sometimes it's also like, oh, I think they actually miscalculated and it's much bigger than they're saying. So we try to look at that as well and then also give them feedback and be like, oh, I think your TAM is way larger than you're thinking. But in general, most VCs, at least the ones on our platform, are looking for at least a 15 billion TAM before they even think it's interesting enough to talk to a founder. Like if
Why do
it's
you
like,
think? Why do you think that's the magic number? Is it
I have
like
no
thinking about
idea.
the 100 million revenue?
They're
And
just like, yeah, they're
yeah,
just like thinking about, yeah, how can we scale this to a unicorn? What
yeah.
is the biggest market size in order to achieve that? I
There's
think.
like this really famous example of like people who passed on Uber investors. They're like, how big's the taxi market? Oh, it's only, in this case, maybe at the time it was 7 billion. You're like,
Right.
not interesting. But like they failed to see kind of how big the market could be.
Yeah.
Tends to be one of my least weighted things, I think. Like I have passed on a deal or two in my time with the TAM, but it has never been like, it's always about like how big could the market be? Because you got your top down, which is what you're describing,
Yeah.
which is like kind of existing, and then you have your bottoms up, which is like how big it could be.
Right.
That's kind of interesting. How do VCs differ between kind of your pre-series A, your pre-seed and seed kind of frameworks? What are some common differences or commonalities between those investors and of those stages versus like the series A, B, and C ones?
Good question.
One of the things you said that I found really like my ears perked up was the coachability. Like when I'm investing in a seed stage, I'm not thinking about their coachability necessarily. I'm thinking about like, can they ring the NASDAQ bell someday? Do I see them like on CNBC talking about their amazing $1 billion company? And, some of the best founders are just not coachable at all. But that's where that kind of question came from. Like, what are some differences you see? Because you work with both, you might call the early and the mid-stage investors.
I would think, and not to generalize, but typically the early stage investors.
This podcast is all about generalizing, so let's just generalize.
So the early stage VCs I see are the ones that are way more hands-on. Like they do whiteboarding sessions. They really sit down with like the founders and really want to help them. The later stage funds I see more, and the larger ones that are big names that everybody knows, typically just throw cash and try to have the portfolio effect do its work. And I feel also, especially, so we're New York based, so we're like the underdog in venture. The East Coast VCs are more hands-on versus the West Coast is kind of what I'm seeing. The East Coast ones have to fight more to get into good deals. So maybe that's more of like the hustle and bustle. And they know that when we get into a deal, they want to like leave a mark on that portfolio company and it truly help them and be like, I actually helped them get to this big enterprise contract, or I helped them actually do the go-to-market properly, or whatever it is, strategic partnerships. Whereas maybe the really big funds on the West Coast, they don't have time for that. So they put more cash to work and they just pick the best founders that maybe can just run on their own, and all they needed was capital.
Yeah.
But my experience is most founders need help. And if it's just in one thing, I think there's very few founders that say, oh, all I need is capital and I'm good. I know how to make this a unicorn. So I think that's like the biggest difference, is like just how hands-on they are.
What about in the way that they evaluate deals? You mentioned one thing, which is the portfolio effect, right? Which I think is very real for bigger multi-stage VCs. They're just hitting the index for their stage and congratulating themselves, I think. But no offense to anybody out there, but like, how do they, like, as they look at deals to look at, what do you see some differences in the frameworks?
Yeah. So I think also later stage funds, they have fund math that need to stick to. So they have very strict guidelines. So like, we need to get 10 to 15% ownership in every round. If our minimum check is not even going to be the size of the round, what can we do? Like, they're not going to say bye to a startup that would have been perfect for them.
That's crazy.
But it doesn't work out because they're like, well, we can't put enough skin in the game. Because for them, it's like, why would I write a 1 million check if normally they want to write a 10 million check? Right. I'm like, why would you take a little bit of something? But they're like,
gotta write 10 on 100. Got to get my 10%.
They just don't want to. Yeah, because the fund math just doesn't make sense. They need to put proper money to work.
Yeah, there's some really famous examples. Because they have like a massive fund that
they need to deploy.
Yeah, there's some really famous examples of VC firms that missed out because of that ownership thing.
Yeah, I mean, Bessemer has an entire website dedicated to that, like a landing page where it's just like all the ones they missed. It's cool to read.
Oh, that's cool. Yeah. That's I gotta go check that out. So it's all the ones that they missed because of it's their anti-portfolio. Here's all the ones we missed and why.
Yes. Yeah.
Wow, that's amazing.
It's called anti-portfolio. Yeah.
Yeah. What a cool thing to do, right? To kind of just be that vulnerable.
And like Airbnb was in it, Apple way back, like some big names were in it. eBay, so I worked for Citi, and in corporate banking when I started, the big story was that they now wanted to be more innovation. That was like 2010. That was like the beginning of innovation, where they said we never want to turn away anymore a company like eBay because they had, and that became like a huge account for whoever the competitor bank was that got them.
I got an existential question for you. That just kind of occurred to me. I think you might have founded this firm at exactly the right time because it's been so hard to raise capital for startups. Do you feel like you've benefited because of the macroeconomic headwinds? And do you feel like if you would have started this in 2018, you would have been as successful? Or is it because it's been so challenging that startups are like, yeah, please help me?
I think startup founders always need help fundraising because not everybody has the network. They didn't go to the right school. They didn't work at the right company. They're immigrants. Like they don't know who they should know.
No.
I think we would have had it way easier if we would have started this in like 2018, 2019, because we were just writing checks. Like everybody would be just writing checks into the deals. That's why I feel right now it's so tough because we have to find the needle in the haystack during a time where so many startups are actually burning and crashing just because they needed capital and they couldn't get the capital. They could have been unicorns. They just didn't find the investor to actually back them at this time. And we can only help that many. And we're still in the business of making money ourselves. That's why we only help startups where we're pretty sure we're going to get them like 20 plus investor intros and they're going to get like 2 or 3 checks in through us. And otherwise, in a top market, I think you would take on more companies that you think, they need a little bit more traction, but whatever, will help them. Now we have to be way more selective.
Now, when you guys sign a contract with a startup, is it just for this round only? Because once they've made that relationship, it's kind of a multi-stage deal or something.
So when we introduce them to an investor, they only pay us on that first check that comes in this round. So if they come later pro rata or even more, we don't charge for that. So for us, and the key is we also don't charge much. We have a 3% success-based fee on the capital we introduce. We've helped 33 startups raise over $140 million so far in 2.5 years.
Wow.
We've already had 4 founders that came back to us for subsequent rounds. So we did like a seed round, then we did debt, then an A. We've done A, debt, now a B. And then we've done like a couple like bridge rounds in between for founders. So I think it's a testament to they trust us. They've seen the value in us because they come back. So they're signing new contracts each time. So it's a new contract because ours only extends to like 18 months. And then that's typically the time it takes between one round to the next. So they keep coming back, which we like. Nice. And then investors also are coming back. So we now have like an investor who now invested in the 4th company through us. Which is also exciting.
And I've done at least 2 or 3 at this point. So that's great. How do you guide a startup between equity and debt? Like, what is that conversation like? And what should startups think about as they're considering that?
Yeah, so coming from the public side and banking, it's completely normal. A company builds their capital structure with equity and debt. Mezzanine, like they stack it.
Right.
On the startup side, a lot of VCs do not advise startups to do that. It might be a selfish reason, but really what we're trying to help founders find out is, especially the ones that now raised a lot of money 2 years ago and now are running out of money and their valuations are too high, but they have strong revenue and revenue growth. We tell them, why don't you do a non-dilutive or like venture debt round that will give you more capital to scale, put on the marketing machine, grow into more revenue so you can actually do a proper up round, like a proper nice valuation uptick. Instead of doing another equity round or a bridge at like flat valuation or just a mini uptick. And we've had now a lot of startups that have really benefited from that. And it might be just like a bridge financing and it takes us 6 months, 12 months, 18 months, and then they can do another equity round. VCs, on the other hand, are kind of a little bit against debt, it seems, because obviously they know they're now on the bottom of the totem pole should the company go bust.
It's like super preferred lick pref sitting in the stack now.
Exactly. But if you
believe
took
on an extra million. No, you took on a bunch of debt ahead of my preferred shares. I'm not happy about that.
But VCs need to also see that this is a way to actually scale the company into profitability, most likely even, and just have it scale.
It's an interesting, decision to make, right? And I guess it's all situational. Anything else you would advise founders to think about?
Debt and equity, obviously, when you're ready. So I think the 1 million revenue mark onward is like when you're a good candidate already for debt. B2B SaaS ARR companies get better deals than the ones that are more transactional or service-based or usage. And then obviously not all money is green. So on the equity side, when you're fundraising, but also picking like investors that actually can help you. Don't only pick the VC that you think is going to write you the bigger check or even the same size check. So we've had that now a couple of times where we've introduced a founder to several investors that wanted to invest. And then it was up to the startup to then pick, who do I pick and choose? And then we're like, okay, look at their portcos. Are there any synergies that could have with some of the portfolio companies?
Right.
Or look at like the background of the GPs and like how can they actually help you? Like have they actually pitched you? Because a startup is always in this bad position where they pitch and pitch and pitch, but when do they actually get pitched back and who they should pick? And then we always say like pick like who you think is actually most beneficial to you. Right. Also who you like, because you're gonna have these people on your board. So like who do you like? Who do you think you can work with? Who do you admire? Who do you respect? And like basically in the end it's humans investing in other humans. So even though it's LP money.
Yeah, no, I like that framing. So looking forward over the next, 6 to 12 months, I have, we have the big Fed meeting coming up. Like, what's your crystal ball for startup fundraising and fundraising?
Yeah.
Asking for a friend.
So obviously, I hope it's a rate cut. I think a lot of signals seem to point towards we'll have a rate cut. Maybe it's 25 basis points, maybe it's 50. We'll see. But that will be a good signal going forward, because as you know, the Fed is completely FOMC like meeting. It's completely separate from politics. So we need to make sure that rate cuts happen, because that will bring liquidity to the market. And who needs liquidity? LPs, so they can invest in funds, number one, but also that funds actually have capital to deploy. So it's kind of like it's a trickling down effect. So that's really the goal. I'm like, let's just get to 2025. So all that is behind us. Get this like rate cut behind us, and that should help. Because I'm hearing from a lot of VCs now, LPs are not even making capital calls. So it's like tough, because LPs are like, oh, if I'm getting good money in equities, like why should I?
They're making the capital call and the money's not coming in.
Correct.
Oh wow.
Yeah.
That's dangerous for those LPs.
Yeah.
You can get kicked out of the fund and lose your money. Don't do that. Make your capital call. What other advice would you give founders kind of looking to raise?
Well, so number one, it's get your company ready for a raise. So have your story ready. The deck doesn't have to be beautiful. I think a lot of people spend too much time just trying to get like the super flashy deck. It just needs you to need your problem solution. Mm-hmm. Obviously, traction is very important. Have your story right. And then you're ready and prepared to go raise.
I like the team slide. Really get that's your story right, which is like, why are you the right
early
team? Why
stage
now?
Especially. Yeah. I like on the early stage companies, I prefer the team slate in the beginning. If it's a later stage company, team slate can be on the back, because then the story of the company speaks for itself. But yeah, you're right. Because in the beginning, investors invest in the startup founders.
Because you look at a lot of decks as well as I do, what are some decks that you see that you're like, man, I've seen like 10 of those this month, or 10 of those in this like quarter, and like, why is this one going to work? What is like a common thing where you see and you're just like, gosh, I don't even want to work with this?
You mean same sector over and over, or something specifically
same
in
solution, same problem solution area?
I mean, we see a ton of like social marketplaces where I'm like, do we need another one? Like I've seen a lot of like social network ones. See a lot of sales enablement and lead gen tools out there.
Yeah.
Where I'm like, is this really tech, or is this just like marketing people writing messages?
Yeah.
We see that a lot. And then there's a ton of last mile delivery solutions. See a lot of those. A lot of neobanks, but that was more last year. I think that kind of stopped. Yeah. Last year and the year before, we saw a ton of neobanks, like bank for influencers, bank for gig workers, bank for Latinx, banks for women. Yeah. Like there's like so many.
For me, it's remittances. It's like remittance from country A to country B, from country B to country C, from country A to country C. And I'm like, why does there have to be all these remittance startups? Is it that complex? So what's your vision for your firm over the next, 5 or 10 years?
Wow. Well, hopefully we're the one-stop shop for private market deal flow. So connecting private companies to private capital overall globally. So right now we're focused on North America, so Canada, US, Western Europe, and hoping to add more regions by then, or maybe we'll have the entire globe by then. And pre-seed through pre-IPO. And maybe even because we have the licenses, we'll do IPOs by then.
Yeah.
And then my really big goal is Diadem Ventures, that we could have a fund as well, because we have so many deals coming through and we're actually sending the best deals to our investors. I kind of want a piece of that too. But right now we just don't have the funds to do it because we need the money that we generate to build our tech, because we're building like obviously a marketplace and we keep adding new features and to keep the lights on.
Yeah, you're almost operating as a venture firm. I mean, Team Ignite, a big part of our value add is our network, right? It's all the thousands of LPs. And, we also have a huge VC database of over 1,000 that is in an Airtable with all their preferences. And I'm probably not doing as good of a job as you are at it. I'm certainly not getting my fee.
We might have to share them. Yeah.
Yeah, but like I think you're already kind of doing the job of a VC. So I think just raising your own fund and starting to place some bets on all the deals that you choose to work with, especially ones that like you're in a unique position where, and I don't know what the Series 7 SEC rules on this are when you're representing somebody and you also invest, but if you start referring, and I've seen this too in my deal flow network where I'll send a deal out and I'm still in due diligence and I'll get like 100 replies. I'm like, oh, this is really hot. This is people really want to invest in this.
Yeah.
Like I better like start looking at this a little closer and get my safe signed on this round. Versus like sometimes I'll send out deal flow and it's just like crickets, and I'm like, that's interesting.
But we're still learning too. Yeah.
I had pretty high conviction on this one, and nobody's responding. But yeah, I think you're well suited. And we could talk offline about raising a venture fund and how to do that, and happy to help.
I would love that.
Yeah, and more to come. We're gonna have some podcasts. Yes, in the future on this program that helped me raise my fund. So we'll be talking about that. So tune in at a later date. Why don't we do a rapid fire?
Sure.
No, this is fun. This is the best part. I try to get to this as fast as I can. Describe your experience at Goldman Sachs in one word.
Intense.
Was it intense? Has it gotten stodgy over time, or is it still like 100-hour weeks craziness?
I mean, before I said intense, I wanted to say brutal, but this was like PR verbiage. I was there in 2009.
Oh yeah, that was an
high
intense
stress
time.
Environment, fast paced, very, very, very smart people that expect the highest on the top.
Yeah.
My record, because that was investment banking, what you always wanted to do, and you thought you were so cool when you said it. My record hours in 1 week were 133 hours in 1 week that I worked, and that was like I'm cool.
That's
and
just
now
like
I'm just
going
like, that
to
was so
sleep
sad.
and working, and then going to sleep and working.
Yeah. Basically, you just slept 4 hours on average. But yeah.
Yeah, I had that same experience.
You just went home to shower and then you just went back.
Yeah, 2006, and I never got up to 130, but I definitely got up close to 100. I'm like, what am I doing? Like, what am I really? And I looked at guys that were 20, my age now, in their mid 40s, but I was in my mid 20s at the time. I was like, those guys look miserable. Like, I don't want to end up like these guys. And I washed out and went and taught high school math for a while, trying to figure out what I do with my life.
I love that.
That was my, now I'm a VC.
How you got the sanity back and you were like, okay, let's get back to what's actually important. Yeah.
I spent about 5 years just backpacking around the world and like doing meditation retreats and stuff and like trying to heal myself from all the trauma of my childhood and from Wall Street. But anyway, are you an early bird or a night owl?
Night owl. Might have been because of banking, or banking was perfect for me. But yeah, I typically work late at night and go to bed late.
Yeah, me too. This is a constant fight I have with my wife is like, I come alive at like 9 or 10 at night and I'm ready to go, you know? But
I want to have all the big conversations at like 10, 11 p.m. I'm like, let's go.
Yeah, that's when I'm fired up. But then I also stay up late and I have to sleep in because I need my 8 hours of sleep. So it's a constant like, okay.
Well, luckily I survive on like 6 hours.
Well, I can't do that. I just came back. We're recording this the day after Labor Day. And we're camping at a family camp, really fun place. But I was sleeping like 10 or 11 hours every night.
Oh, wow. How does that even work? I wish I could sleep past like 7, 8 hours. It just doesn't happen. I automatically wake up. I don't know why.
I think there's something about being in a tent and it's cold outside in the mountains and you're just like, snuggled up in your sleeping bag and you're like, all right, I'm going to go to bed at 10 and wake up at, 9 or 10 in the morning. What's your favorite book? I'm
sure a lot of people give you like really cool business school books, but like my favorite book was like Angels and Demons or like Da Vinci Code.
That was so much fun. Yeah.
I mean, it's like
I read
old
that
times,
backpacking in Europe like 20 years ago. And so I'm
That's
in
nice, right? When you
Rome.
read books,
Yeah.
you remember where you were. Like when you listen to
Yeah.
music, you remember where you were and what time of life it was. Yeah.
Yeah. Those are
We're in
fun.
Europe, so were you in Italy? So it made sense.
Yeah. We're going to Italy next summer as a family. So we're kind of going back into Italian mode right now, watching
Nice.
Rome, the series on HBO, and the Roman Empire on Netflix. So we're kind of very much in that right now. Name a country you want to visit but haven't yet.
South Africa. Like I've been wanting to go there forever. Like Kruger National Park, see like the animals, safaris, all of that. I'm very into that. And then wine. I like South African
the
wine.
wine down there. In grad school, I was able to go for like a seminar in international business for like a week to South Africa, and it was an amazing trip. I did Kruger and the Cape Town and all the vineyards and all that stuff. Really beautiful country. But it actually feels like California in a way.
Really? Okay.
Yeah. Yeah. Like you're kind of down on the coast. You're like, oh, this like looks like California, Oh, I'm drinking some wine. This kind of tastes like California wine. Anyway, no offense to anybody in South Africa.
So I don't have to go anymore.
Yeah. Just go to California. What's the best piece of advice you've ever received?
We only regret the chances we never took. That's like a big one.
I love that. Nothing ventured, nothing gained. What is the most, I mean, you're a founder. What's the most challenging part of being a founder CEO?
Well, if I could like slice myself in like 10 pieces, I could do like so much so fast. But I think the biggest challenge you have, especially as like a early stage startup, is like, what are our short-term goals? What are long-term goals? How do I make sure we have revenue? How do I still have capital to deploy into our tech so we get the tech better and get like full like innovative product? That's like, I think the biggest things that make it tough every day.
Yeah. What's your favorite way to unwind?
So we talk about work hours. So I typically work from 9 to 6 every day. And then from 6 to 9, I'm with my kids always. So those 3 hours, I'm just with them.
You get to work from home too, right? You're like me. Yeah. So that's like you just walk out of your office and you're there.
Exactly. I just open the door and there they are.
Yeah, that's great.
And then I do kindergarten with my kids. So I have 2 boys, 2 and 4-year-olds. So we just play pretend. I play with them and it just catapults you back to like when you were a kid, which I love. And just for 3 hours per kid, everything. It's kind of like when you do yoga. And then I work again, like from 9 to midnight.
Wow. That's amazing. I try to not work too much after 9. I'll do like 30 or 60 minutes, something like that, but not too much. I try to actually do like, just try to unplug. It's hard because I'm a night owl, but anyway. Any hobbies or interests that are of note? I have here sommelier trained.
Yes.
You're like,
so
wow.
Undergrad, I studied hotel management. And so I am a professionally trained chef. So 3 semesters of the schooling was actually learning how to cook and garde manger and everything, pastry and chucking oysters and throwing lobsters in hot water and taking apart an entire cow and learning all the fillets. And we also got like a half sommelier license. So I love wine.
That's a thing. That's like a half license.
Well, so they taught us everything for it, but we didn't take the actual license.
Oh, okay.
Yeah.
I heard it's really tough.
Behringer is actually the sponsor of my school. So École Hôtelière de Lausanne, the Lausanne Hotel School, was sponsored by Behringer. So we had like a wine tasting room by Behringer. So we had a lot of Behringer wines as well. But like that's where like they...
Are there good Behringer wines? Aren't those the ones at the big bottles on the low shelf?
Yes, they have those as well. Yeah.
The finest Behringer wine, comes in like a normal sized bottle. Where can especially founders and VCs get in touch with you and find out more?
Yeah, so diademcapital.com, super easy to sign up. I'm very accessible.
DIADEM for those, because I said it incorrectly before the show.
DIADEM, capital.com. And then I'm very accessible on LinkedIn as well. So Stephanie Rieben. And then de Roquefeuille, because it's my French husband's name. So I'm originally German. He's French. I hyphenated the name just to make it super complicated.
Yeah, I saw that. Pretty long. I have it in the show notes. I was like, I don't know if I would be able to say that whole thing. Very long name.
It's for the French speakers. Then they'll see it and they'll be like, oh, a fellow European. And then maybe they'll sign up to the platform.
There you go.
Yeah, so you can reach me on LinkedIn and then email. So if you want to reach the team, it's equity@diademcapital.com. So that's for equity deals. We also have debt@diademcapital.com. You can always hit up Joe Hamill, my co-founder. So he's typically on the founder side and I'm on the investor side.
Oh, okay. Nice. That's why we know each other. And I don't know Joe that well. That makes sense. Well, thanks so much for coming on. This was a really amazing episode. I'm sure all the founders and VCs will get a lot of benefit from it. Thanks so much.
Yeah, appreciate it. Thanks, Brian.
Thank you.